So they get into these for the tax benefits, and at the end of the year comes and they're like, hey, the GP just sent me this amazing tax seg study. Like, they go to their CPA and the CPA is just like, well, I don't have anything to offset this against. Like, you only have active income. That's the point that we're making for the audience. Is like, you have to, I mean, it sounds silly, but you have to make sure that if you're getting into something for tax benefits, you'll actually benefit from them.
1, 2, 3, 4.
Welcome to the Small Business Mentor podcast, where we shine a light on the black holes of business growth with your host, Alan Pentz. In each episode, we explore the leaps and bounds entrepreneurs make as they push their businesses beyond the 1 million mark into the realm of professional sustainable growth. Stay with us as we navigate the journey from brute force to finesse.
Well, with us today, we got kind of a different guest, Aleksey Chernobelskiy. He'll give you a little bit of his background, but his basic focus is on helping limited partners who invest in mostly real estate deals, so private market deals, investing in general partners. So he is a super smart dude, knows the whole space, and was a quadruple major in college in like finance, econ, accounting, and probably like math. And then, like, I don't know, 5 other subjects. So welcome to the podcast, to the smartest person I've had on the podcast yet. So welcome, Aleksey.
Thanks, Alan. Yeah, so just a little bit about me. I focused too much on education and not enough on work experience in college, as you just noted. Then I went off to do all types of things in the investing world on the principal side, did a bit on the public market side, a little bit of distressed debt, some value investing, and then ultimately landed in real estate when I moved to Phoenix at a place called Store Capital. Ultimately, there I became an SVP and led 2 teams, underwriting and portfolio management, where I essentially oversaw the entire underwriting process. We had dozens of deals per week typically, and we also had about 3,000 properties to manage all across the U.S.
Wow.
So,
any kind of focus at Store?
So Store stands for single tenant operational real estate. So first of all, single tenant. So think like freestanding real estate, i.e., like not a mall, for example, or a strip mall, for example, right?
Like triple net kind of stuff?
Yeah, exactly. So that they would be freestanding with one tenant inside. The tenant would be one that needs the building for operational purposes. That's the O, which essentially excludes, like, for example, like an office building, right? And a few other use cases. So in other words, we would only invest in buildings that had a P&L at that specific property. And so we did sale leasebacks, if that means anything to the audience, across hundreds of properties in the US every year. And yeah, it was fun, So then I left, started my entrepreneur journey. And as you said, now I advise LPs, both existing LPs and deals, and ones that are considering entering into a transaction. I would say, to your earlier point, probably 70% of the requests I get are on the real estate side, but I've also had my fair share of others. Like, I've had quite a few VC requests. I just advised someone on an oil and gas investment recently. A lot of like small business type syndication stuff. So it's a diversified crowd.
That's awesome. That's awesome. Yeah. So, and I had just a little plug in the beginning. I did a little course with Aleksey just on looking at 4 deals. I think there were about 6 or 7 of us. And it was really helpful because you really got into the details of looking at these syndications. And believe me, nobody is looking at these in the detail that they need to be looking at them, which is one of the reasons I wanted to bring you on because, I think for a lot of small business owners, the first thing they do when they make some money is figure out how to put it into LP deals in real estate. That's like almost the axiomatic first move. Second move, I think also like buying their own buildings and things like that, which is a little different when they're a GP, owner-occupied real estate. But why don't you talk a little bit about just what you see from LPs, like maybe, to the extent that you worked with people who kind of self-employed or run their own business. What are kind of the things they're usually looking for, and sort of like the big like things that they don't get
Themes.
right or need to learn about? Themes? Yeah.
Yeah, look, I'll just highlight the biggest theme I think is I think small business owners or mid business owners as well think that they can transfer their risk tolerance to LP investing. Um, and I just think that's like a very risky approach, right? And let me just dive in for a second and explain. So, and I say this very humbly. I'm, about a year into my small business journey personally. So, from what I can tell so far, like if you really think about the successful business owners, they typically have a decent risk tolerance, right? Like they need to take on risks, they need to be uncomfortable, perhaps at a bunch of different times in their journey. But when they're taking on the risk, this is the key part. When they take on that risk, they are not in full control of the outcome, but they are in pretty decent control. Like if something goes haywire, they can pursue another plan, fix the boat, so to speak, right, or whatever. But at the end of the day, they're kind of the driver. And so what usually happens is someone will have an exit. They'll make 20 million, 50 million. In some cases I've seen 100, right? And they'll call me and they'll say something like, hey, like I just had an exit, I have 20 million liquid and I'd like to invest it into a syndication. And I'm like, whoa, like what do you mean it? Like do you mean all of it? And what do you mean syndication? Like why is that singular? Right? And some of them respond with like, well, what do you mean? Like I'm going to find one really good deal, and I'm going to invest it. That's what I'm calling you. And I'm like, well, maybe you're calling the wrong person. But like I don't think it's a good idea, right? To do that because again, once you invest as an LP, you're passive. That's one of the benefits, but that's also one of the drawbacks from a risk perspective. And unlike your small business journey where you were a successful risk taker, risk taking in the LP investing world, I think has to be taken slightly differently.
Yeah. And so what do you usually see them not? So first of all, you talked about, hey, I want to go put in a bunch of money, concentration, risk. And, to be honest, most of these people made their money by having concentrated risk, right? So then
Yeah,
they kind of
but there's a
they
one big
seek
difference.
that.
That's what I was saying.
Right.
Yeah, yeah,
Yeah, they don't control this and they don't
exactly.
understand it,
Yeah.
right? And the other factor on that I would say is they made that money over time and they learned a lot about the industry that they worked in as they were, maybe they were a couple $1,000,000 and they were doing stupid stuff and it didn't really hurt them that much. Well, now you've got 20 million as a result of all that knowledge. You can't go like buy that knowledge in another industry like that, right? So
Yeah.
you're not spending 10, 15, 20 years working your way up in real estate. So what do you think some of the most common mistakes they make beyond, like when they look at a deal, what are they not seeing that's sort of like behind the curtain?
So again, I think if you're talking about small business owners placing capital, probably the biggest one is just allocation, right? And like what I would call like over risk taking. I don't think that's a word, but the second biggest thing is probably just having humility. That sounds weird, but like I think when someone exits and they have a big exit, they have a really good big reason to assume that they're really smart and they are, right? But I find many people assume that those smarts transfer to other areas, right? And that combined, and by the way, they do to a certain degree. Obviously, like you have to have an analyzing brain to some degree, and you ask good questions, right? You know how to negotiate potentially, right? So there's a bunch of things that you learn. But then the second thing is that this sort of oversimplification of real estate transactions combined with some GPs that oversimplify it as well. Like, I mean,
Right.
you have some GPs that are pitching and it's like, well, you just invest and like it's mailbox money. It's super easy. Like the returns are guaranteed. I mean, there are so many things that's
Mailbox
sort of
money.
being peddled, right? And so when you combine those two, you can get like a very terrible outcome, right? Because you have someone who is looking to place money somewhat desperately, like it's almost like burning a hole in their pocket. And then you have someone else that's like, hey, this is super easy. Like you can't lose money. It's a real estate building and it's going to go up and it's going to be great. And again, I've seen people sort of stumble there. It's just, I think
Yeah.
it's really good to know what you don't know. And I think that's probably super valuable, especially if you're placing large amounts of money or amounts of money that are very meaningful to you.
So key things that I took coming away from working with you was number one, I think small business owners, like everyone else, but they particularly hate taxes, right? So they will do all these crazy things to avoid taxes. Like, and a guy I'm actually interviewing after you, Greg Crabtree, says never spend a dollar to save 40 cents, right? So, but business owners do that all the time. And I think one of the key things here is that often the tax benefits of real estate are a leading, feature of a deal. And the reality is most small business owners can't take advantage of it beyond, the deduction against the income coming out of the project itself, right? Or other passive investments they have. So can you talk a little bit about sort of that active passive difference and how that plays out?
Yeah, I first of all probably should speak to a CPA. I'm not one, but I'll share what I know, and what I've seen kind of people stumble on. A lot of the investments don't lead with this is a great investment. Many of them lead with this is a great tax shelter, right? Or tax benefit. And that might be true, but I think what your point is that in the vast majority of cases, unless you're actively involved in the business, such as a GP, for example, to an LP, you only get those benefits if you have other passive income that this depreciation benefit would offset, right? The second thing that I think people forget about is even if you do a cost segregation analysis and you get all of this, all of these benefits, what you're actually doing is you're essentially like getting a loan from the government in a sense, in the form of like a tax benefit and to the extent that the building gets foreclosed on, right, or something happens, sometimes
Or if you
people get like
sell
a
it, right?
or sometimes if you sell it, exactly, depending on what you do with the proceeds, right? But like
Right.
you then you but I would say I want to go back to kind of the foreclosure, right? Because
Mm-hmm.
you
You've seen
you
that
have like this
recently, I assume.
you have this double whammy. Yeah, I've seen it and I've written about it. Like, so you get a notice from your GP that's like, hey, sorry, but like we lost the building. And you're like, whoa, like, what do you mean you lost the building? And it's like, oh, well, your $100,000, it's gone. You're like, oh, that sucks. Okay, so you take a week to get over that, right? And then February, March rolls around and you get, a notice from your CPA. It's like, hey, what happened to that building? We haven't gotten any details on it. It's like, oh, well, I lost the investment. It's like, oh, but didn't you take a tax benefit from it a year ago? Yeah, well, so, and it's like, oh, well, now you have to pay some of that back. And they're like, wait. So what you're telling me is I lost 100 grand that I originally invested, and now I owe the IRS something too? And the answer is yes, right? And obviously there's like, a lot of details here behind the scenes that I'm not
Of course.
capable of answering, but I've seen this happen many times. And so tax benefits are nice, but invest wisely.
So just to clear up a couple of terms here, and again, I'm not a CPA or tax professional, so go talk to yours. But the reality is to get your income, and say most of us are pass-through corporations, LLCs, S corps. That's active income. Any profits passing through to use depreciation from a real estate deal, you have to be a real estate professional, and there's various other. So that requires at least 750 hours a year working primarily in real estate, and then there's some requirements around how much you spend on time on this individual project versus other people, and so anyway, it gets complicated. But the only way you can write that depreciation, and what he was talking about is you go in and you cost seg a building, right? So you're like, bought the building, it's on a whatever it is, 27, 29 year depreciation schedule. I can go take, but the roof is on a 10-year, right? So I can go take more depreciation on the roof sooner because I have to replace it sooner. So you have to cost segregate parts of the building, and then you can take more depreciation, right? But if you're not active in the business, you're an LP by definition. You're not active. You cannot use that against your active income. Only other passive income. So, like if you had stock investments or something like that, capital gains, you could use the depreciation against that. So that's one thing that Aleksey was just talking about there. The second thing is there's this depreciation recapture. So basically, the government, in multiple tax bills over the year has accelerated depreciation. So you can take more in the beginning. It used to be 100%, and then it was 80 last year. Now it's 60 this year. But if you sell the building before the end of that depreciation cycle, you owe the balance of that back in taxes, right? Because you took that benefit up front. So those are just two things. Super complicated. Part of the reason why you just don't walk into an LP deal and just without thinking about this stuff, right? And often you'll see this with like mobile home parks, other stuff. Because they can depreciate more, there's more crap in there to depreciate, they'll really sell the tax benefits. And you got to be really careful. So talk about some of the other. Go ahead.
Just really quickly, like I think many times people get into these for the tax benefits, which in and of itself I would advise against. But let's put that aside. So they get into these for the tax benefits, and at the end of the year comes, and they're like, "Hey, the GP just sent me this amazing tax seg study." Like they go to their CPA, and the CPA is just like, "Wow, I don't have anything to offset this against. Like you only have active income." That's the point that we're making for the audience. Is like you have to. I mean, it sounds silly, but you have to make sure that if you're getting into something for tax benefits, you'll actually benefit from them. Again, it sounds silly. It sounds so silly and simple.
Happens all the time.
I can tell you that many people, and I think some of this is on the LPs, to be fair, because you got to do some due diligence, and some of it might be on the GPs, you might say too, because in the marketing materials, it, sometimes oversells the tax benefits. Many times it doesn't tell you that you can only offset it with passive income, and so it's
and these are not SEC regulated fundraisings, right? That in almost all these, I mean, there are LP deals where they're raising from non-accredited investors, but almost all these deals are accredited investors, correct?
Almost all, yeah.
Yeah. And so the regulation on what they can say is really loose. So a lot of assumptions can be made. A lot of claims can be made that you could not make in an SEC filing, where you'd have to say, here are all these risks, right? You don't have to say that as a GP.
Even then, in the accredited investor world, people will still send you the PPM, and it'll have 20 pages of risk disclosures.
Right,
no one reads it. In some sense, Alan, it's like, and I speak about this pretty publicly all the time. Like if you don't know what you're investing in, or you don't understand it, like you should just not invest. It's okay. Right?
Yeah.
It's fine. And one of the ways to understand whether you understand what you're investing in is how well do you understand the risks. And so what I think probably 50% of LP investors will tell you to a question like that is, like, what do you mean? Like, I read the risk section of the PPM, and it says that, like, if we get another COVID, like, that might impact this investment. And it's like, no, that's not what we're talking about. Like, what specific variables can move in the deal, and how do they impact your returns? And which of those, because I mean, of the variables that can move, there's tens of them, if not 20 of them. I mean, there's dozens of these variables, and it's up to you to determine the ones that have the highest impact on your overall returns. So which ones are the largest catalysts, right? And to those, once you've identified those, so how do you feel about those? Like, are you comfortable with those assumptions? Are you not? And once you can answer some of those questions pretty comfortably, then I think you're probably ready to invest.
Yeah. And really that, like what I was trying to figure out when I was working with you is like, what's the rank order of things you need to look at? And it really does change deal to deal, right? Because a deal is packaged in different ways. So like, it could be like a lot of the return depends on a debt refinancing, right? Yep. But what's the rate on that debt refinancing? I mean, these people, and the Federal Reserve can't figure that out, much less the GP in your deal, right? And so I think you like when we looked at that, that was a big assumption in one of the deals we looked at was like, okay, where's the sensitivity analysis around where rates might be? That's what I want to see, right? And another thing you might look at is like, hey, this is a fix up, right? It's a value add. So you might, I remember one of the people on the thing was in construction. They're like, these costs to like fix up these apartments is like way below market, right? Or it might be the experience of the GPs. And I think one deal we looked at, they all like, a couple of them had a good experience, but they hadn't worked together. So it was like, oh, you got to underwrite the background of the people. What are some of the other common things you see that are like key?
Yeah, there's a lot to look. I mean, so I have an article addressing this specifically, which people can find it. I think if you Google top 15 syndication mistakes, it'll come up. I think that probably the biggest slip up, so to speak, for folks is the exit cap rate. That has been like a very big one because they'll look at a deck and the returns look so nice, but many people don't realize that the returns are essentially just a function of the valuation in 5 years. And the valuation in 5 years is determined by two things. What is the NOI in 5 years for most properties?
Net operating income of the property.
Yeah, net operating income on the property, meaning how much money is it generating? And then what is the cap rate, i.e., like what valuation are you going to put on that NOI, right? And so both of those change. The difference, though, is like the NOI is, I want to say this lightly, like it's somewhat in control, right? The GP is somewhat in control of the NOI, but not fully, right? Meaning, at the end of the day, the market rent isn't really up to you. Like you can renovate something and move rents up if you're correct in your thesis, but rents are determined by the comps around you. And if the comps around you start going down for whatever reason, because of supply or because whatever reason, like you could stand in front of your apartment building all day and it's not going to help you get your rents up, right? Yeah, at the end of the day, it's just it's kind of it's market dependent, right? And so again, you can do certain things to move the market that you're competing against. For example, like non-renovated or renovated. In some cases, like renovated apartments don't make sense. It doesn't make sense to renovate apartments based on how much money you're putting in because it takes so many years to get it back, right? There's all these types of things. But anyway, so at least with the NOI, you have some control, right? With the cap rate, however, in the vast majority of cases, you have zero control. Like that's macro dependent. And 9 times out of 10, I think one of the biggest exceptions is like if you're taking a property and converting it to some other use case, then you could be taking, I guess I'll just give you an example. Like if you take an RV park, right, that's short-term stay, right, you are changing the nature of the property to like a multifamily property. Let's say you build a multifamily building. Okay, so those two NOIs will trade at different levels, right? Because naturally one is more risky than the other. But yeah, like I think that's a really big one that I think
and I think we've seen, like over, and I want to kind of get into what's been happening in real estate the last few years, but one thing you'll see a lot of is like sort of this reliance on cap rate compression, right? And so the cap rate is the total value, the NOI divided by the total value of the property, right? So if you can either have the market go up, right, over time for value, or you can add value to the company or to the building, you can end up like exiting at a cap rate lower than what you're getting out of it, right? Because someone will pay more for that stream of cash flows. So it's kind of a weird cap rate compression is kind of a counterintuitive calculation.
Yeah, but I think one way to think about it from like a business owner perspective is it's no different than EBITDA multiples, right? Or cash flow multiples. Like if someone is building a business and they have $1 million in cash flow, I'm just using simple numbers, and this types of businesses trade at 10 times, so that means your business is worth roughly $10 million, right? And so
at a 10% cap rate.
Right. So essentially, like it's just a multiple, right? And the question becomes, what do you expect EBITDA multiples to trade at over the next few years? You get what I'm saying?
Right.
It's not different Because like for you to come out and say, well, I think my small business right now is trading at 10, but in 5 years it's going to trade at 20. Is like, well, like it might, but like, what is that based on? You
Right.
know,
Right.
it's based on a ton of things that are macro related. Part of it is related on the industry that you're in. Maybe that industry gets like bid up by a bunch of different factors. Who knows? The point I want to make is that it's like a very macro bet.
Right. And so, and just to be clear, so again, the cap rate is the inverse of the multiple, right? So
Right.
it's the if you have a 10 cap, you're making a 10 cap on $1 million, it's $10 million deal.
Yeah.
And so you think about it like, a lot of these owners are looking to buy or have bought businesses. Like, how much weight do you put on the 5th year EBITDA projection on the company you're looking at? Like, basically nothing, because you think it's bullshit. And like, yes, real estate is less risky and is more regular, but it still has a lot of risk in it. So those out year assumptions
Yeah.
are kind of, whatever. So, and I think one of the things, but similar to businesses, is that we were in a declining interest rate environment for the last 40 years, and so it did tend
Longer, but
to,
yeah.
yeah, you did tend to have this in as the rates kept going down, the cap rate that people would take got lower and lower, right?
Mhm.
And so it did make a lot of sense. Like, when you bought buildings, you could probably rely on an increase in the value of your cash streams as the rates, to borrow to buy them, the other rates available
Yeah,
in the
I would
economy
say
went down, right?
it made sense from a financing perspective, right? Because financing was so cheap, and when financing is cheap, you're able to pay more for a property, all else equal, right? But I think where I think is it's a little questionable whether it makes sense, right? And that's where some of the syndications are in trouble today is sitting back in 2022, early 2022, you could have financed the property at 2-3%, right? And that's nice, right? Because that's like such a low interest rate. But the problem is some of those were done on floating rate debt.
Floating
Some of
rate.
them bought rate caps. Those rate caps have now expired, and now the value of the property went down, and that's where like things start to get difficult.
Right. So you go in, you buy something kind of cash flowing at 5%, you finance it at 2.5, 3, you are making a spread. Now,
Yeah,
like, you can go get a T-bill for 5.5. So
yeah.
why would anyone buy this property at that price, right? And they can't finance it. So talk a little bit of what happened in the market over the last couple of years, because it's been a definite difference.
Macro level, if you think about the property, it only spits out so much NOI and net operating income, as we talked, cash flow, right? And when rates rise to the point that they've risen over the past 2 years, either the debt on the original investment was fixed, in which case you're fine, or it was floating, in which case you basically have like two options. Either you had a rate cap, but in that case, most of them have expired, or you didn't have a rate cap, which means your cash flow has been basically like struggling all leading up until now, and many of those people didn't even survive. Of the folks that have survived, they have like a big financing challenge because they can either buy a new rate cap to fix the debt again, but that now comes at in some cases 10 times or some cases even more expense than it was before in like early 2022, or you can sort of do a capital call. It just in terms of like the sources, the property can't fund the new rate cap, right? The property can't fund a cash in refi, which is sort of like a new term that most people haven't heard up until recently. Um,
You
and
don't
and
want to
so
hear that word,
you're
right?
yeah, so you're kind of forced into a few tough decisions, right? How do you get the
So
capital?
talk
What,
about
what,
that. Like, if they can't refinance, well, a lot of times
yeah.
they'll come back to the LPs, right? And so talk about that process.
Yeah, I mean, and so typically like the dream, right, is you buy a property and then a few years later you improve it and then you cash out refi and then you're sitting pretty. I think now what's happening is valuations of properties have dropped, the loan to value percentage that a lender is willing to extend has also dropped. So, for example, if you were originally able to get $80 per $100 of property value, now you take the same exact property to the lending market and someone might give you 50 or 60. So then you have this delta, let's call it 30, right? Between the 80 of principal outstanding you have in the property, and now someone is giving you 50, right? So how do you come up with the 30? Like you have to get the lender out, there's a maturity, but you can't get it anywhere else. So that's where you sort of either need to work something out with the existing lender through a modification, or raise the capital somehow externally. Sometimes that's a pref that's put in front of the common equity. And sometimes that is a capital call, where they reach out to existing investors and say, look, like, we basically don't have many options here. We're going to lose the property and you should contribute more. And that itself, kind of brings up any questions like this.
Yeah, like, is it worth it?
Does it make sense to invest, or does it not make sense to invest?
So I guess I haven't seen a ton of these distressed deals. So what's your sense of what's happening? Is it kind of all over the place, or like, do you see are large parts of the market going through capital calls and bringing in new capital with preference over the existing capital and those kind of things?
I mean, I think it depends how you define large, right? For me, it's large. Yeah, meaning, no, I mean it. Like, I think it's very large for me. It's large for you. It's large for all the LPs that are experiencing it. I think for every LP that realizes that their deal is gone or their investment is gone, there's probably 9 or 10 that don't know it yet, right? So
Right.
from that perspective, it's very large and it's very
Just because they haven't heard maybe cash
yeah,
flows
they haven't
stop for
heard
a
anything.
while.
And yeah, maybe the cash flow stopped, but we're reserving the money, and right now all of a sudden they get a notice saying, hey, like, we tried to reserve money, but we had to use it for other stuff and we don't have any cash. And they're like, what do you mean? I thought you were reserving for a year and a half. What happened? And it's like, well, okay, like, if you want us to show you what we used the money on, here's what we used it on. And it wasn't like fraudulent, like they used it for real stuff. But at the end of the day, like, they have a maturity in a few months, or rate cap expired and they can't pay the new interest, and they're stuck, right? So, from a dollars perspective, I really don't know how big. My hunch is, if you're talking about LP, I'm just talking about retail, right? Of
Right.
the retail money that was raised, let's say from 2022, 2021 maybe, up until 20, I take that those like 2 years, 2020 through
Yeah.
2022. Okay. I think there's hundreds of millions that is, like, not gone because the deal is still owned, but it's gone effectively. And again, like I said, I think 90% of those LPs don't understand. And you have to keep in mind, like, when you say a few hundred million, it might be in the billions, by the way, I don't know. But when you see those numbers, it's like, oh, like, that's one check from like a pension fund. Like, what's the big deal, right?
Right.
But like, the reality is, we're talking about people that have invested 50K. And once you do the math, it's like, whoa, that's a lot of people. The magnitude of people that are being impacted, I think there's a lot. There's a lot of people
Yeah.
here.
Yeah, I mean, it was. I remember looking at the deals back then. It was a feeding frenzy, and cap rates were plummeting, and
Yeah.
people had all this cash from different programs and the government throwing it around. So it got
Yeah.
a little nuts there, and it's going to take I think one of the key messages I take is it's going to take a little while for this to unwind, because in some cases banks
Yeah.
are extending and pretending a little bit, right? LP or GPs are doing whatever they can. I mean, I hate to say it, but they're getting fees on stuff too, so they don't want it to go away.
I think it's much bigger than that, Alan. There's ethics, right? Which I hope people have ethics, but putting ethics aside for a second, the like the,
I have
the
less faith.
conflict of interest, or let's call it the alignment of interest between GP and LP, starts to diverge very quickly in
Yeah.
bad scenarios, because, like, the LP just wants as much money back as soon as possible, but the GP, they don't want to, like, put a deal on their track record that returned half the cash they invested. They're going to keep that thing forever. They don't want to be on the cover of the Wall Street Journal because they lost people's money. So the incentive from the GP's perspective is like, it's gonna be fine. Like, let's just buy another rate cap. We'll get all your money out. But you look at the projection, it's like, I don't think you're gonna 3x NOI on a 99% occupied property in 2 years, right? Like, I don't think that's realistic. But many LPs, by the time it gets to me, it's like 90% filled. It's pretty wild. Like, meaning I don't know, sometimes I wonder what I'm missing, but it's like many people just get scared. Like, a lot of these emails are like, we're going to lose the property. Your investment is going to be gone. Like, this is the last chance. You have until Friday. And it's like, you ask them some basic questions like, so what's your plan? Like, what do you want to do? Is this the last capital call you'll need, or is there plans for another one? In some cases, you won't even hear back. In other cases, they'll be like, I'm not sure what the plan is, but like, it's going to be great. But you only have 24 hours to contribute until we lose the property.
Yeah. And if you don't contribute, you get crammed down, right?
Yeah. Oh, yeah. Yeah. Well, usually they don't even say that. If you don't contribute, you lose everything, right?
Yeah, exactly. And so are you seeing any trends? I mean, obviously we all know office is troubled, and so I think that's kind of a no-brainer, but are you seeing any other trends in other asset classes? Are some like more popular now, some going down, or do you get a sense of that?
I'm not sure if there's trends, but once you think through the trends, they kind of make sense. Like, for example, a clear trend is like most of the capital calls that I'm getting are from multifamily in the Sun Belt, right? So, okay, so you might say, well, that means that, meaning you might conclude that Sun Belt multifamily is worse than other stuff. And I would say I don't think that's true, right? Because what's also true is from 2020 to 2022, I'm just pulling this stat from my head. I don't think it's not accurate. It's just my guess. But like I think I don't know, 80% probably of the money from retail went to Sunbelt multifamily.
All right. So there's just more there to.
Yeah. So like, is it so surprising that 80% of my requests on capital calls are coming from Sunbelt multifamily? Not really. Like that actually makes sense. You know what I'm saying? So, like how many retail syndications were done in the office space? Not many. I mean, it's like a fraction of the dollars outstanding to multifamily, right?
But I bet you're not seeing a lot of industrial having that trouble, are you?
I've seen some.
Oh, really?
I've seen some. Yeah. A lot of like stop distributions, a lot of rents that are softening. I think one of the industrial challenges was like, how do I describe this? I mean, I think multifamily's fault, so to speak, a few years ago was like cap rates are going to keep going down forever. That's where they kind of missed the boat a bit. On industrial, the narrative was like, well, we have like nowhere near the need, the supply of industrial buildings that we need. Everyone's going to need shipping, and everyone went like gangbusters on like class B, class C industrial. Many people started building and investing in those, and a lot of those aren't performing so well. Generally, they're okay. Like, they're not issuing capital calls from what I see, but they're also not paying distributions,
right.
and like and some of the things are pretty challenging in terms of lease up, and it's just another craze, It's like
But have you seen like values starting to change in the market? Like I stopped really looking at deals. Yeah, like or like the deals that people are looking at now that they like I was looking at stuff maybe 6 months ago, it didn't make any sense. Like the deals I was looking at didn't make any sense to me. They didn't pencil. Do you see that shifting?
Well, so I think those are two separate questions.
Yeah.
Property values are all down. I mean, it's hard to find an asset class where property values are not down against like Q1 of 2022. I think in multifamily, like the average multifamily deal in the Sun Belt was down 25% or something like that, against March 2022 values. In some cases,
what do you think the REITs are that are down there, like the publicly traded stuff?
A lot of the REITs are down. that's what's
So I'd say
interesting
they're
is
down
like
40%, right? Or 30%. They're down even
that's
more.
a lot of the people that follow public REITs are talking about that, right? Meaning, and then you can kind of tie this back into B REIT, for example, right?
Yeah.
Which, maybe that's a whole other discussion. But my point is like prices are they're definitely down, but prices are down because borrowing at 8% is different than borrowing at 3%, right? That's one reason why they're down. I think another reason why they're down is people have different expectations of what's going to happen to NOI between income growth and expense growth, right? Like not everyone is sitting here underwriting deals assuming NOI can just continue going up. They
Right.
realize that, inflation might hit more and expenses might rise, and perhaps they can't assume 5% rent growth every year. Maybe it should be zero. Maybe it should be negative in some markets for some time. You know, it's tough. It's tough out there. Meaning, there's no question that property values are down, but the question isn't are they down. The question is are they down enough to make a new deal make sense,
Well,
right?
and I worry
I,
that the difference between the public and private still hasn't closed. Like the private is still elevated
I
compared to
don't.
the
I don't
public
think it has
value.
closed. Yeah, I don't think it has closed. Yeah.
So to me, that makes it all the more. You need somebody like Aleksey all the more if you're going to do a private deal now, because the chances that market in the LP offering space, the syndication space, is market in the public space is, I think, pretty small. Like most likely, you're better. This is my impression. Most likely, in
Yeah.
general, you're better off in a REIT right now than you are in an LP deal. Now, of course, there are deals that are going to be amazing and people are going to do incredible things. But I'm
Yeah.
just saying, on average, it feels a little scary right now.
Yeah. It's
Yeah.
interesting. I actually just wrote an article, I think it was yesterday, on sort of like the going in assumption as an LP. And I thought about this for a long time. Like when you get a deck, should your assumption be I'm investing, and I'm going to look for evidence to not invest, right? Or should your going in assumption perhaps it should be I'm not investing, and you need to convince me to invest. It sounds like a meaningless conversation, but I think it has a lot of roots in figuring out like how much counter evidence do you need to get to the other side, right? Depending on the side that you take. And so I think I agree with you. What I concluded, I think, is especially in today's market, there's a lot more bad deals than good, and I think that's even true in a good market. And so, as a random LP, so to speak, that doesn't have any secret sauce in terms of like the deals that you're getting from the best GPs or whatever, I think you're much better off. The baseline assumption being I'm not investing, and then can you get over the hump? Like you open slide one and slide two, and it's like, oh, like okay, like I'm getting warmer, right? And then yeah, anyways,
I suggest
all that
taking a
to say.
cold shower. Yeah. Um, so let's talk, and I do think that's going to change, right? So, you look at like, I've seen some stats that like the delivery of new multifamily buildings is at an all-time high right now, but then also permits to start building are at an all-time low as well. So that means the supply will go through in the next couple of years, and then there'll be a dearth of supply. Then it's probably
Yep.
time to buy, right? So it's not going to stay that way forever. So let's talk a little bit about building your business. So
Yeah.
you've been out and you've got a Substack newsletter you run, and that's called. Can you give us the title?
LPlessons.co. Co.
Substack.
LPlessons.co or LP Investing Lessons is the name to it.
LPinvestinglessons.co, and I subscribe to
LPlessons.co. LPlessons.co.
LPlessons.co, and then you just started a podcast. Is that right?
Yeah, and that can be found on there. I'm sort of working on getting it out to Spotify and all these other things, but for
Yeah.
now you can go to lplessons.co /podcast.
And then you've been doing a couple of, you're doing these classes, teaching people about LP investing. And then it sounds like you're doing a lot of consulting work with people who have
Yep,
made or looking to make investments.
exactly. Yep.
So what's it been like trying to build a business out on your own?
I think the best way that I've described it to folks is the good days feel way better than bonus day, let's call it, at a W-2, which was a good day. Um, but the worst days definitely feel a lot worse than a W-2. Things are personal. So I think at least for me, like that it exacerbates itself, so to speak, in good times and bad times, and sort of have to get used to it and learn how to
Yeah.
deal with the ups and downs.
So I think it's a good, like what I love about what you're doing is a really good niche, right? So there's very few people that are doing like LP side advice, investing, blah, blah, blah. What I would be concerned about in a business like yours is just like the regularity of income, right? So you've got, consulting gigs, they're one off, maybe, hopefully you get somebody who does a lot, but you're not getting like a steady stream of income coming
Yeah,
in.
it's very much irregular, and
Yeah.
for example, some people might reach out and they might invest and they don't have anything liquid for 5 years, let's say, until some exit.
Right.
And so the income is not it's not regular. Also, like in some cases, people get my feedback and they were like, "What the heck? Like I had no idea what I was getting into." Like it made me
I'm out of here.
realize, like you made me realize that I'm just not ready to invest as an LP. And to me, actually, I mean, in some circumstances, obviously I have conversations with them, but in some circumstances, I think that's good, right? Meaning, if perhaps some GPs will disagree with me, but I think if you scared of something that you're not aware of, and speaking to me, let's say, makes you realize that like, oh, I can actually lose all my money, and you didn't know that going in, like you probably shouldn't have invested. I'm not saying you attribute 50% probability to lose all your money or something crazy, but like not realizing that it's a chance, I think is wrong.
Yeah.
So yeah.
You've been listening to the Small Business Mentor podcast, brought to you by Alan Pentz. For more insights on how to navigate your business through its black holes, visit @apentz on X. Don't forget to search for Small Business Mentor in your podcast app to subscribe. Thank you for joining us, and here's to your next leap in business growth.